Looking for a dividend aristocrat on sale? Want a market smashing yield near 4% and double-digit dividend growth? Like the idea of being greedy when others are fearful? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high-quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is one of the world's largest asset managers. Asset management is a fantastic business model. The base upon which fees are levied, assets, are often exponentially rising over the long run. And that means exponentially rising fees. And that means tons of inherent growth built right into the business model, which translates over to the dividend. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of T. Rowe Price Group Inc., which appear to be trading at a significant discount today. T. Rowe Price Group Inc., stock ticker TROW, is a large investment management company that manages assets for individual and institutional investors. Founded in 1937, T. Rowe Price is now a $30 billion by market cap investment management colossus that employs more than 7,000 people. With approximately $1.4 trillion in assets under management, T. Rowe Price ranks as one of the largest US-based asset managers. Asset management is one of the best and most lucrative business models in the entire world. That's because of its basic structure. T. Rowe Price charges fees to manage assets. Well, these fees have two huge built-in advantages. First, the fees are subject to exponential growth. That's because asset managers like T. Rowe Price have tremendous exposure to global equities. As the world's economic output continues to grow, global equities should continue to compound. The base upon which fees are levied is exponentially rising. Second, these fees are incredibly sticky. Once assets are in place and being properly managed, the path of least resistance is to simply leave them in place. Stickiness is reinforced by performance. Regarding performance, Morningstar states this, and I quote, "At the end of March 2022, 69%, 68%, and 79% of the company's fund AUM were beating the Morningstar category median on a 3, 5, and 10-year basis respectively, with 50% of fund assets closing out 2021 with an overall rating of 4 or 5 stars, better than just about every other US-based asset manager we cover," unquote. Stickiness is further bolstered by specific account types. Morningstar adds this, and I quote, "T. Rowe Price has historically had a stickier set of clients than its peers as well, with 2/3 of its assets under management derived from retirement-based accounts," unquote. This stickiness limits outflows, which helps the firm to ride out volatility, and it also creates an environment for relatively smooth upward business results across revenue, profit, and the dividend over the long term, despite volatile asset pricing in the short term. In fact, T. Rowe Price has increased its dividend for 36 consecutive years. That makes the asset manager a vaunted dividend aristocrat. No volatility in that impressive track record. The 10-year dividend growth rate is 13.3%, and that's a growth rate that's been rather consistent. On top of the double-digit dividend growth, the stock offers an appealing yield of 3.9%. This yield easily beats the market, and it's a stunning 140 basis points higher than its own 5-year average. With a payout ratio of only 38.8%, the dividend is highly secure. I like dividend growth stocks in what I call the sweet spot, a yield of between 2.5% and 3.5%, paired with a high single-digit or better dividend growth rate. This stock offers both a higher yield and a higher dividend growth rate than the upper bounds of that sweet spot. It might be one of the best combinations of yield and growth in the whole market. Looking at business growth, T. Rowe Price advanced its revenue from $3 billion in fiscal year 2012 to $7.7 billion in fiscal year 2021. It's a compound annual growth rate of 11%. Fantastic top-line growth here. Not a total surprise, as the last decade has been great for U.S. equities. Meanwhile, earnings per share grew from $3.36 to $13.12 over this period, which is a compound annual growth rate of 16.3%. Whenever you see double-digit long-term growth across both the top line and bottom line, you know you've got a special business on your hands. We can also see where double-digit dividend growth has been coming from all this time. It's been supported by underlying EPS growth. A combination of margin expansion and share buybacks help to drive excess bottom line growth. Regarding the latter point, the outstanding share count is down by approximately 12% over the last 10 years. Looking forward, CFRA currently has no growth forecast for T. Rowe Price's earnings per share over the next 3 years. It's unusual that CFRA has no forecast here. In late December 2021, which is when I last analyzed and valued this business, CFRA believed that T. Rowe Price was going to compound its earnings per share at an annual rate of 14% over the next 3 years. It would be fair to scale that expectation back quite a bit, as 2022 has produced extreme volatility and big pricing drops across global assets. This has caused asset depreciation, outflows in assets under management, and lowered fee revenue. Indeed, the company ended fiscal year 2021 with $1.7 trillion in assets under management. T. Rowe Price finished Q1 fiscal year 2022 with less than $1.6 trillion in AUM, and a recent filing by the company showed slightly over $1.4 trillion in AUM as of April 30th, 2022. As great as the asset management business model is, it's not perfect. Volatility will affect AUM. The good news is that there doesn't appear to be an issue with client-driven outflows. Of the $136 billion decrease in AUM for Q1 fiscal year 2022, more than $130 billion was due to market depreciation. Less than $6 billion was due to client net outflows. This relates back to the stickiness I touched on earlier. On one hand, the near-term picture looks suboptimal in terms of assets under management, fee, revenue, and earnings per share growth. The company's Q1 fiscal year 2022 report showed a 24% contraction in year-over-year earnings per share. On the other hand, the lowered earnings base makes it easier to put up a higher growth rate in relative terms on a go-forward basis, but this only happens after a painful reset in that base. I still believe T. Rowe Price is positioned for strong earnings per share and dividend growth over the long term, but I do acknowledge that the near term looks a bit ugly. I also think it's important to remember that the stock yields nearly 4% here. That's well above its norm, which compensates today's investors for some of the bumpiness. With the yield so far above what it usually is, the company has some breathing room in terms of dividend growth. They simply don't have to grow the dividend at the same high rate as when the yield was closer to 2%. Either way, with a solid business and a low payout ratio, I would expect T. Rowe Price to grow the dividend at a high single-digit rate over the long run. It's hard to dislike the long-term setup here in terms of both yield and growth. Moving over to the balance sheet, T. Rowe Price has an outstanding financial position. The company has no long-term debt. That's right, it's a flawless balance sheet. Profitability is terrific. Over the last 5 years, the firm has averaged annual net margin of 35.6% and annual return on equity of 31.7%. Circling back around to a point I made earlier, net margin has noticeably expanded over the last few years. Net margin was routinely below 30% in the earlier part of the last decade. I find almost nothing to fault about T. Rowe Price. This is a debt-free dividend aristocrat with sky-high margins that has grown at a double-digit rate for a long time. I'm not sure what else you'd really want out of a business. And with economies of scale, performance-oriented brand value, and switching costs that keep assets sticky, the company does benefit from durable competitive advantages. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. The very business model is a risk due to the direct exposure to volatility from global capital markets. There's cyclical risk here. A recession would hurt asset valuations, assets under management, fees, and profits. There has been a pronounced shift to passive funds throughout the industry, which reduces demand for active management and the associated fees. I view the company's size as somewhat of a risk. Their AUM base is so large, it's difficult to grow at a high rate in percentage terms. I think these risks should be carefully weighed, but the quality of the business strikes me as far more weighty than the risks. And with the valuation severely compressed after the stock's 50% drop from its 52-week high, the business looks particularly viable at this point in time. The stock is trading hands for a price-earnings ratio of 10.0. That's well below the broader market's earnings multiple. It's also much lower than the stock's own 5-year average PE ratio of 15.2. There's an even bigger disconnect here in the cash flow multiple. The price-to-cash flow ratio of 8.0 is less than half that of its own 5-year average of 31.0. And the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7%. I'm being super careful with the dividend growth rate here. The company's demonstrated earnings per share growth and dividend growth over the last decade are both about double this mark, and the payout ratio remains low even after factoring in a recent hit to earnings. I understand the near-term picture doesn't look great, and the recent 24% year-over-year contraction in earnings per share shows that. However, the 50% drop in the stock's price more than reflects this. That said, because of an unusually high amount of uncertainty and volatility, it's appropriate to be conservative. I think it's highly likely that T. Rowe Price does better than this expectation over the long run, but I'd rather err on the side of caution. The dividend discount model analysis gives me a fair value of $171.20. The reason I use the dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates TROW as a 4-star stock with a fair value estimate of $155. CFRA rates TROW as a 3-star hold with a 12-month target price of $140. I came out high, which surprises me. Averaging the three numbers out gives us a final valuation of $155.40, which would indicate the stock is possibly 25% undervalued. Here's the bottom line, guys. T. Rowe Price Group Inc. is a high-quality business with some of the best fundamentals I've ever seen. This year has been bumpy, but this company is ultimately riding favorable fee-based exposure to global capital markets higher. With 36 consecutive years of dividend increases, a low payout ratio, a yield near 4%, double-digit dividend growth, and the potential that shares are 25% undervalued, long-term dividend growth investors ought to seriously look at this debt-free dividend aristocrat right now. And now for a special news announcement. Albemarle Corporation, stock ticker ALB, has done it again. For the second time in only a month, the company raised its guidance. The company is now forecasting full-year adjusted earnings per share of $12.30 to $15, well above previous guidance of $9.25 to $12.25. And that latter guidance was a big boost in and of itself, much higher than the initial guidance for full-year adjusted earnings per share of $5.65 to $6.65. So full-year adjusted earnings per share guidance has been more than doubled. Like I've said many times before, Albemarle Corporation is a great way for long-term dividend growth investors to ride the long-term wave of lithium. Thanks so much for watching. Hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.